The speed and magnitude of the virus, our response to it, and the market moves sets this current environment apart from past experiences. The future road looks bumpy, but we know that every bear market comes to an end, not every company will go bankrupt, and that companies and society will emerge stronger. Tune into this podcast as we dive deeper into these topics and more. Hello, this is Jeff DeMaso, and I'm the Director of Research here at Advisor Investments. We're here with another Advisor You Can Talk to podcast. Today I'm joined by Steve Johnson, a portfolio manager at Advisor Investments. Steve, thanks for joining me.
Happy to be here today, Jeff.
All right, Steve, it has been 1 week since Dan and Jim last recorded a podcast, and well, a lot has happened since then. The virus has spread extremely fast. For example, just in New York City here a week ago, there were 2,000 confirmed cases. As of last night, the number is over 15,000. And it's not just the spread of COVID 19, but it's the response to it, which is moving extremely quickly. I mean, the Fed has gone from being pretty much on hold to full blown crisis management mode in a matter of few weeks, which we'll talk about in just a minute. So I don't know about you, but at least for me, time is moving both extremely fast and slowly. Each day seems to zip by, but each week feels like a month or so.
Without a doubt, and I'm definitely grayer than I was 2 weeks ago.
Yeah, I mean, not only are things moving quickly, but the magnitude of the moves is what kind of jumps out to me. We've seen some large record moves in the market, and I think it's those two factors, this is speed and the magnitude, that sets this environment apart from past ones, makes it feels unnerving, and is probably contributing to the graying that you're experiencing there. Let me offer one fun fact, though. Since last week, at least as of last night's close, and I suppose given the speed of things, I should say that we're recording this on Wednesday morning. But with yesterday's rally, stocks are actually higher than they were last Wednesday. That that most people don't realize that.
Yeah, that's a pretty amazing statistic, especially with the speed in which these markets are moving.
Yep. Yep. So today, I thought we could kind of maybe recap some of the major items from the past week. In particular, I want to talk about the bond market and the Fed. And then maybe let's try and cast our eye ahead if we can and talk about some of the economic data coming down the pike, because that's going to be pretty shocking to people, I think, coming down as soon as tomorrow morning with initial jobless claims. But let's start with the bond market. I thought bonds were supposed to be safe, but we've seen some real turmoil in the bond market with some funds, showing some pretty shocking losses, and even high quality corporate bonds have sold off a bunch. So what's going on in the bond market? How should we be thinking about bonds, and maybe talk a bit about the Fed in there as well?
Great. Well, thanks, Jeff. Yeah, and I think the bond market is really what moved the Fed to act. So as you mentioned, we saw really some major dislocations. And what I mean by dislocations is really seeing prices widen out by huge amounts last week. And so, as you mentioned, we saw some bond funds suffer some very large losses. And there was really fear that the bond market was getting away from the Fed. And by that, we mean they weren't acting in a rational manner. And so, as an investor, we own bonds to stabilize the portfolio and to act as a cushion. And with that cushion being removed, it seemed there was some real panic. And so, thankfully, the Fed came to the rescue. And what we've seen is the Fed's new mantra, I think, Jeff, is whatever it takes. So they have expanded their bond buying program. In essence, have created multiple programs, expanding it to the corporate bond market, not only to treasuries, but to the corporate bond market. And so what that has done is really stabilized prices over the last couple of days and has given us a shot of stability that was badly needed. And I think what investors need to realize is that the Fed has been there before. So we've seen obviously in 2008 we were somewhat slower to react, but because of that lesson, the Fed has really stepped up to the plate here. And what they have done with their program, in essence, now with $4 trillion worth of ammunition, has been able to stabilize the bond market and really create a sense of calm out there that didn't exist last week. So now we're starting to see the bond market behave better. Corporate bonds, municipal bonds, that is very reassuring for me as well as it should be for investors.
I completely agree. The Fed really stepped up as that buyer of last resort. Do whatever it takes to keep the markets functioning, to keep the plumbing working, so to speak. And one the flip side of those, stress in the market and seeing bond prices fall is that it creates opportunity. The valuations or the level of yield that you're picking up from corporate bonds now is looking historically pretty attractive. Things could always always get a little bit worse from here. But we're seeing some opportunities in markets, and in talking to portfolio managers, they're starting to see some opportunities as well in the credit markets. And I think, to your point, the Fed stepping in and getting things working again lends some comfort to be able to take advantage of those opportunities.
Yeah, without a doubt. I mean, as long as the plumbing, to ensure that the plumbing is working, just like your house, just provides a sense of stability and calm that we needed. So, with the bond market being stabilized and the Fed, Jeff, I want to turn it to you a little bit and to talk about the economy. What are we going to see here in the upcoming weeks in terms of data, and what should we be prepared for?
Yeah, well, to use a technical term, we should be prepared for some pretty awful economic data. Um, the estimates I'm seeing are all over the place, but seeing, second quarter GDP declining, at annual paces of 9, 10, 20. Even this morning I saw one at 40%. Those are some pretty shocking numbers. And I get it, because typically in a recession, people go out less, but right now, um, they're largely not even going out at all. One thing that stands out to me is compared to last year. So last year we saw manufacturing come under pressure from the trade war and tariffs, and it was the service side of the economy that carried us through and contributed to most of the growth. And the service sector is a lot larger than the manufacturing side of our economy today. But what we're seeing today in the early, the data is just starting to come in, but the early signs are that the service sector is what's getting hard. One measure of activity fell to 39.1. The prior lowest read on record was 49.3. And again, that kind of makes sense. Big cities here in New York, where I am, we've shut down all non-essential services, right? So restaurants, bars, movies, theater, sporting events, like the kind of the service sector has really come down. Um, and I think what we need to really be prepared for and is going to be a test of how bad these numbers are going to be, and also how we're going to respond to them, is tomorrow's initial jobless claims. And that's the number of people who are applying for unemployment because they were laid off. And to use another technical term, I think it's going to be ugly. Again, I'm seeing estimates that it could top a million in claims, and some estimates I've seen for 2.5 million. And that is a shocking number. That is a lot of people who are working, just a week ago, just 3 weeks ago, who are suddenly out of a job. Again, the speed and magnitude of this is what really stands out. Um, I think it's very easy at this point to get stuck in a bit of a negative spiral. Um, but two notes on that are just one: not every company is firing people. You've got some like Amazon and Walmart, which are hiring to meet the demand that they're seeing. And then, even bigger pictures, just the numbers are going to be bad, absolutely, and earnings numbers are going to be bad, but we will get through this. Not every company is going out of business, um, and I think that leads to, maybe when to tip it to you, Steve. If I miss something on the economy, fill in that hole and that gap. But maybe talk a bit about the stimulus bill. It sounds like it's not a done deal yet, but the Senate and at least the White House have agreed preliminary to a deal. And while we said the Fed has done a lot, it's kind of time for Congress to step up and try and provide some support through this sharp decline here.
Without a doubt, Jeff. And it seems like, gosh, we've been sitting around waiting for Congress to do something. I know since Sunday night, when we were having meetings and talking about it, it appears that we have the framework for a deal, which is very important because now, people are throwing out numbers like 6 trillion, and we want to make sure that we're accurate. So the real bill here is about a $2 trillion stimulus bill. The other 4 trillion is, as we talked about, what the Fed now has the ability to use with their different programs. But what we are seeing is American families are going to get checks. So $1,200 per purse for each adult, $500 for each child. We are going to see unemployment insurance be expanded. We are going to see loans to businesses over $350 billion, another $500 billion for those industries that have been most impacted. We're also seeing aid to cities and states as well as direct aid to hospitals. So here we are seeing, and I think to your earlier point, Jeff, the extent of this crisis has been dramatic, and the speed in which it has occurred has been dramatic. And so, what that has required is really an overwhelming response. And we saw that over the weekend by the Fed. Now we're seeing it with Congress. And the question is the timing and how long this virus will remain. And in the meantime, we're seeing this really, I wouldn't even call it stimulus. I'd say it's relief directly to the consumer and to businesses to hold us over while the virus takes its cure and we start to see the economy recover. And I think that is the most important piece. Now that we have the Fed in place and Congress acting, now I think we can feel a little bit more comfortable about the economy, hopefully starting to stabilize over the weeks and months to come.
Yeah, I really like that idea of calling it relief over stimulus, as it's really trying to expand that, safety net under families and companies that are going to need it through this period. To always try and bring it back to the portfolios and investing. Steve, you're a portfolio manager. Uh, what are you doing in this environment? There's a pretty high degree of certainty. The range of outcomes seems really wide. How are you thinking about approaching the markets?
Well, Jeff, we're taking a look at each company that we own in the portfolio. And as a dividend growth manager, what we're looking for are those companies that are not only going to be able to survive, but keep paying their dividend or even increasing it over the next year. And so, as we've seen over the last couple of weeks, there have been a number of announcements from companies that have been forced to suspend their dividend. So, what it's forcing us to do is to really take a look at our portfolio, maybe look at companies that we thought were too expensive to own before that have now come back in a range that make them attractive. And so, it's allowing us to upgrade the portfolio to look at names that perhaps we would never be able to own before. Now put them in the portfolio and really take the opportunity to enhance the quality of our portfolio for the next months and years to come.
Yeah, I completely agree. I've been talking to the portfolio managers on the mutual funds that we own on clients' behalf and in our own portfolios as well, and hearing from a lot of other managers in the industry. And that's kind of a common refrain I'm hearing is looking for an opportunity to increase the quality of the portfolio, with the idea that at the end of a crisis and coming out of them, that strong companies get stronger. They get to take more market share. There are fewer competitors. Um, so let's maybe try and wrap up here. As I said at the start, it's the speed and the magnitude that sets this current environment apart from past experiences. And I completely understand that the future road looks bumpy right now, if people are even willing to look at all ahead to the road. But we do know that every bear market comes to an end. Not every company is going to go bankrupt, and that companies and society are going to emerge stronger from this. And right now, stocks and bonds are arguably on sale. Prices could certainly get cut further, but stocks and bonds are kind of this funny asset where when they go lower in prices, investors seem to want to do less with them. Whereas usually when things go on sale, everybody rushes to buy. So maybe if we can try and flip our mindset on stocks and bonds and think about them being on sale as opposed to being at a loss. That might help us think about getting through this difficult period.
Jeff, I think you're exactly on point here. As you know, we send each other so many different articles and pieces of research, and one last night that I read that struck me. It said the bottom is the day before the recovery begins, and it's impossible to know when that bottom has been reached ever. I remember I being in 08, 09, and when the market turned around, no one really had a good reason why it did, but it did. And so it's impossible for us to predict the bottom. There's no way for us to say when the bottom is at hand. However, we can say, as you just alluded to, the conditions that make bargains available certainly are materializing. And so we've been going through the portfolios, taking a look where we can now really create some opportunity for investors where we can upgrade the portfolio and a year from now be in a better position.
Well said, Steve. Thanks for joining me today.
My pleasure. Stay safe, everyone.
This has been Jeff DeMaso and Steve Johnson from Advisor Investments. Thank you for listening to the Advisor You Can Talk to podcast. If you enjoyed this conversation, please subscribe and review our show. You can check us out at advisorinvestments.com/podcasts. Your feedback really is always welcome. If you have any questions or topics you'd like us to explore, please email us at info@advisorinvestments.com. Thank you for listening and stay safe.